And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. It is, of course, that day. It is election day. That's absolutely right. And as we get into the grind of it here, I mean, this is what this all comes down to. And as we've been talking about here for the last several days, is that there's consequences to elections, right? So what comes out of this, of course, is what kind of policies that we're going to get, whether it is a infrastructure or tax rate changes, those type of things. This is all the you get the government you vote for. So this is the day where we cast, as citizens, right? We cast those votes. And I just want to clear up one thing real quick, because I actually called a professor at I think it was Harvard last night an intellectual idiot. Because he actually made this comment. He said the Electoral College is racist because Wyoming is like 75% white. California is only 37% white, and voters in Wyoming have their vote counts 5 times more than a vote in California based on population, right? That would seem to be the case. But this is because he doesn't understand we're a representative republic. We're not a democracy, right? And so please, if you're a professor, read your freaking Constitution. It's not real hard, it's not long, and it's in easy language. So, I mean, it's pretty much readable by anybody. Maybe we spend a little bit more time doing that. We wouldn't have these problems.
What was the professor purportedly of?
I'm not sure.
Not civics.
Not civics, obviously. Anyway, as we get into the election, yes, your vote does count, but also importantly, remember we are a representative republic, and what we vote for, those policies do have outcomes. And what we've been talking about here lately is as we get closer to the actual election, the markets have a very, very good predictive ability of who wins elections. And one thing that we're going to kind of get through today is talking about the impact of elections and markets and how these all kind of work together. Now, investors tend to look past personal politics because they have one goal. I want to make money, right? So I want to invest in the areas that I think will benefit the most coming out of an election, right? And so what has actually been showing up there? Now, since 1984, the stock market has predicted with 100% accuracy who the president is going to be when they're elected. When the market is positive, 3 months prior to the election, the incumbent is reelected. When it is negative 3 months prior to the election, the opposing candidate has been elected. Also, importantly, taking a look at, the policies that we talk about, whether, it's higher tax rates or lower tax rates, whether it is a infrastructure program, more spending, those type of things. What areas are rallying the most tells you what markets are betting on as to which policy that they expect to be voted in. So if we take a couple of look at things over the last couple of days, there's been a shift in the markets. As we take a look at the dollar, policies that will lead to lower tax rates and to a stronger economy typically bode well for the dollar. And the dollar's been rallying sharply here over the last couple of weeks, or actually just the last few days in particular, as there's been a shift in sentiment as to what policies may be actually implemented over the course of the next year. So traders trying to get ahead of what they expect the election outcome to be. So the dollar's been getting stronger, meaning stronger economic growth potentially going forward, and of course more business-friendly environments as we get through there. Now, also too, if we take a look at areas like emerging markets, international have been under pressure here lately. We're starting to see some more pressure there. So again, the change in money flows coming out of foreign countries and back into the U.S. also makes a difference. Now, if we take a look at bonds in particular, now one thing's been going on with bonds here, of course, is concerns about where interest rates are going to be headed. Higher interest rates not good. More debt issuance is not good. And really what bonds have been trying to do here as of late, and they've been struggling here to kind of form a bottom, but interest rates have been ticking up here over the last couple of months. It's been one of those things where interest rates have been on the rise because of more debt issuance, concerns about stimulus, these type of things. And so while the bond market is currently stabilizing, what we're seeing here is, again, money flows are still moving into treasuries at this point, trying to build some positioning as we head into the election. Again, this has been more of a hedge really about the outcome of an election more than anything else, and we continue to see money flows going into treasuries here as of late to try to hedge against the outcome of the election. Lastly, when we really want to kind of take a look back at the markets, again, markets are going to be up fairly nicely this morning. We've got futures pointing up about 400 points on an election day. Again, trying to form this bottom here recently after this recent sell-off. This is actually putting in a nice bottom back to where we saw at the September lows as well. A little bit higher bottom. And again, we're starting to flatten out our money flow indicators. So again, as we begin to watch this curve, particularly in the markets, and begin to watch that bottoming process, we're starting to see money starting to reposition themselves back on the long side of the market. In fact, in just the last week, traders have ramped up investment positions into S&P index in particular to one of the highest levels we've seen really since the end of 2019. And short interest on the S&P is very depressed at a very low level. Now, what that means is that when you get a rally here from the market, it won't be really just a short covering binge because there's not a lot of shorts in the markets right now. People have pretty much positioned themselves on the long side of the market expecting a year-end rally. Now, importantly, when we're talking about this, analysts right now, over the course of the next year, expect the market to rally by 16% on average. Now, that's a very big rally from current levels, and historical tendencies suggest that when incumbents are reelected in the presidential election cycle, the returns over the next year tend to be between 12 and 14%. If the opposing candidate is elected, returns tend to be between 6 and 9%. And so what we're seeing here currently is that with analysts expecting a 16% return already, markets being positive heading into election, Wall Street may be already making their bets as to what they expect at least to be the outcome to be. Now look, this is just what markets are saying, and all I'm saying is that markets have a very high predictive capability, at least for the last 30 years, about picking electoral candidates. Again, this is about money. This is not about politics. And then this is about where investors are placing their bets relative to what they expect the outcome to be. So that's all this is telling you, right? One thing that happened yesterday that I thought was interesting is we particularly kind of look at this. Energy has been under just a tremendous amount of pressure over the last really several months, really pretty much since the financial crisis, but also before, the COVID dip here, but it's really just gone nowhere over the course of really the last several months. Oil continues to be under a lot of pressure. We did see some money flow action moving into energy yesterday, actually getting a money flow buy signal here for the first time we've had here in a while for energy. And again, when we start to take a look at what's energy telling us about the election, one of the issues really at hand here is what happens to the energy sector post-election. And again, energy has been extremely beaten down this year. Very distressed levels. There's a lot of companies in the energy sector trading below $10 a share right now, which is a bit unprecedented. And now you're starting to get money flows. Had a big day yesterday in energy stocks, really last 2 days. You've had nice big returns in some energy stocks, money being positioned into energy as we move past the election. So again, which candidate favors energy companies more than others? That's really kind of what the market's already starting to give you some ideas about where they're placing their bets. So again, when it comes to investing, always important to remember, pay attention to what markets are doing, because that's investors are about money. When we come back, we've got a lot more to get into this morning. Real investment advice. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election. Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts. So just talking a little bit about what markets are saying. And look, I want to be really clear here, right? I have no idea how this election is going to turn out, right? I mean, nobody does, right? It's just, we're not going to know for at least a couple more weeks, probably, before we actually find out the election results. And this is because of all the mail-in ballots that we've got coming in. There's every state, right? There's no, and this is the kind of one of the interesting, there's no set standard for processing mail-in ballots. Every state, every county has different rules. Some states, the ballot has to be postmarked on the day before the election. Some of it has to be postmarked the day of the election. They can be counted up to 10 days after the election, but every state's different, right? So there's no uniformity into processing these mail-in ballots and no uniformity actually when they start counting the ballots. Some start counting ballots today, some started yesterday, some start tomorrow. It's just all over the board, right? So I have no idea about the electoral outcome. Neither does anybody else. Polls, all this other nonsense, nobody really knows. Everybody's taking a guess at it, right? All I was talking about in the first segment, though, is that markets are different. It's not really a poll. People can have opinions all day long. When it comes down to money, people are pretty, a bit apolitical, right? It's just I want to make money. I want to make sure I'm investing my money in the right areas. And this is why the markets have a very high predictive capability, statistically speaking, historically speaking, over the last 40, 50 years about determining outcomes of elections, because they're betting on what they expect to be the outcome to be. It doesn't mean that it jives with their personal political agenda. It's just that people's jobs depend on making the right trades. So, I can have my personal political opinion, doesn't matter, but if I don't invest to make money for my clients, I won't have any clients, right? So money tends to override a lot of these other things, and that's why it's important to kind of pay attention to what the markets are doing. But what's important about this is that, as we get into this whole process of finding out actually who the elected individual is, and then ultimately getting into what the policies are going to be, et cetera, and seeing what policies get passed, what policies don't get passed, this is where markets will really start to kind of shape the outcome of investments. One of the areas, as I was just talking about a second ago, one of the areas that's been a tremendous amount of pressure this year has been the energy sector. Historically speaking, statistically speaking. And again, when you talk about history and statistics, it's important to understand that when you're talking about statistical analysis, you say, look at every other time in history when this has occurred, when this has been the outcome. Every single time, 100% of the time, the market has done this. This has been the outcome. There's always there's always that time that it's wrong. So statistics are not infallible, and you should not base your entire analysis simply on what markets say. I would give it weight, right? But I wouldn't base my entire retirement savings on a historical trend of the markets, because there's always that time that they can be wrong. And in fact, statistically speaking, the higher the probability, or the higher the propensity of a previous statistical indicator working. It's been right 98% of the time. The higher that number is, the higher the potential is that next time it will be wrong. right? So you got to take these you got to take all this into account when you're investing your money. Anyway, so let's talk about energy. Energy's been under a tremendous amount of pressure. If you take a look at the sector, we have more stocks in that sector trading below $10 than at any other point in history that I can find, right? Doesn't mean it didn't exist, but I just can't find one. Been just a tremendous amount of price pressure on those stocks. And again, look, a lot of these companies fall into the quote unquote zombie category that we've talked about before, right? These are companies that are only alive because they've got access to cheap debt. But there is a lot of value in the sector. And over the last couple of days, there's been a good bit of money flowing into energy stocks. Now, this is interesting because when we start, here we are at an election. And if you take a look at the two candidates' policies about, who favors energy over the other, there seems to be a good amount of people making a bet on energy over the last couple of days prior to the election. So what do they know? No more than you or I. But they're betting money there, which is interesting. I find that interesting. There's also another factor that I like about energy a lot here. Now, it's still really too early to buy energy companies today. You're going to have plenty of time to buy energy when we get into the environment to buy energy. But there is some things to think about. One, there's a lot of value in some of these companies. Not every energy company is a value company, but there are some companies that have a lot of relative value. In fact, we've done some reports on a couple of energy companies at our subscriber site, riapro.net. And we've gone through a couple of these companies and saying, look, here's some real value. Now, we haven't bought them yet, but we're watching them very closely because this is a sector that has the potential where you could buy stocks that could easily double and triple just to get back to fair value, not even being overpriced, just to get back to fair value. These prices have gotten depressed that much. So there's going to be a lot of money to be made in energy when the time is right. The problem is really twofold for investors. One is that you've got to be willing to make a bet in this sector and just ride it out because it may be a while before it starts to work. Value is out of favor right now. It's growth over value. We're seeing some rotation into basic materials and industrials here because they got oversold on a short-term basis. But again, you could be waiting a while. It could be dead money for a while to invest in energy, but there is some real opportunity there to make a lot of money. Question is just when. But that has a lot to do with ultimately the policies that we promote and push forward over the course of the next 4 years. So policy in this particular case, particularly when it focuses on the energy sector itself, could have a big impact on the ability of that sector to recover, depending on what those policies are. So again, all I'm saying is that there's some interesting activity that's occurring in the energy sector. Been watching it here over the last couple of days in particular. We're starting to see some pretty big money flows going in. So there are some bets being made in the energy sector. Again, there's no need to go panic rush right now to go jump into the sector and start buying stuff, right? You're not going to miss anything. This isn't something that's going to take off overnight and you never have the opportunity to get into it. This is one of those things where you can afford to give up a little bit of the bottom, right? You just go ahead and let the bottom form, know that it's in for sure, and then you can start placing some money in those areas. You got plenty of opportunity to make money, right? The sector is that depressed. But again, it's worth paying attention to. Okay. Now, when we start looking at the outcome of this election, and as we were talking about at the beginning of the segment, we're not going to know what the outcome here is going to be for really the course of the next couple of weeks. And that's barring any type of lawsuit that's filed, contest, et cetera. And there's already a litany of lawsuits already lined up, ready to go. There are going to be lawsuits filed over voter fraud. There's going to be lawsuits filed over ballot counts. There's going to be lawsuits filed over this, that, and the other thing. There are going to be a ton of these issues, which may drag this election out even longer. And so when it comes to managing the portfolio is that you need a set of rules to kind of navigate this type of environment. And this is going to be a much tougher environment potentially than we've seen here in quite some time. More volatility, markets moving up and down a whole lot, things not working that you think are going to work, and other things not working that you thought would definitely work, right? So that's going to be the risk here. And so I've written an article today. It's our Technically Speaking post for every Tuesday we put out Technically Speaking. It's on our website. If you go to the website and subscribe to our newsletter, there's a link at the top of the website, realinvestmentadvice.com. If you click on the newsletter link, then we will email you we only email you 2 documents a week. We email you our newsletter on the weekends by email, and then we email you our Technically Speaking post that comes out on Tuesday. That post updates our analysis from the weekend, right? Because on the weekend, we write about, hey, this is what happened last week. This is where the market's finished. This is what we expect to happen next week. So then after Monday opens up on Tuesday, we follow that up and say, okay, this is what we said. This is what happened. Here's what we project for the rest of the week. So these two kind of work together to kind of keep you on track with what our analysis is and what we expect the markets to do. Today, I'm deviating from that just a hair to talk a little bit about these investing rules that will help you navigate your portfolio management here over the course of the next, month or so, because it could literally be sometime in December before the Supreme Court rules on actually who wins the election. It could drag out that far. How do we know that? Because that's what happened during the Bush-Gore presidential campaign election. Spit that word out. Back in 2000. It took till December the 15th before we actually know officially who won the election. So that's our time frame we've got to deal with. We'll come back from the break and we'll talk about some of these rules to help you navigate your portfolio better. Because look, it's all about your money ultimately and protecting it. And we want to make sure you do that. Be right back for the Real Investment Show. I'm your host, Lance Roberts. Don't go away.
Love isn't always on time.
Listen anyplace, anytime at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
And welcome back to the show this morning, 6:33. So just want to talk about a few of the rules, heading into a, potentially contentious election. Yesterday, we actually added a short positions to our portfolio. Now, let me explain to you why we did that, because we're actually very optimistic on the markets here. Markets are oversold on a short-term basis. We talked about this in this past weekend's newsletter. A lot of the areas that we like have gotten oversold, and those have set up the opportunity here for a reflexive rally in those areas, right? So we still like a lot of the companies that we own. We own Clorox, as an example, had a great earnings report yesterday. Has a lot to do with the ongoing pandemic. People have to sanitize. These aren't positions that it takes a lot of thought process to figure out. But they're doing well, right? And so if we have a positive outlook on the markets, which we do because we're oversold short term, Now, this is contrary to what we were saying a couple of weeks ago. We were warning that the market could sell off because we were very overbought, right? And so we've had this correction here over the last 2-3 weeks. Markets have now gotten oversold. So, the outlook is much more optimistic because of where we are. And again, our job as investors is to buy low, sell high, right? And so that's our job. Right now, markets have gotten oversold. So if markets are oversold, why would we add a hedge? Because we have no idea what's going to happen over the next day, 2, 3. And have no idea how the markets are going to react. So all we've done is just basically add a short position to our portfolio. It's not huge, but it's just enough to give us a little bit of hedge against volatility if markets start to kind of swing wildly one direction or the other. So this morning, markets are, Dow implied opens up 400 points. Now, we saw this yesterday, then the markets actually sold off most of the day, right? We were unable to hold that rally. Could be the same case today. People kind of positioning here for the election, but by the end of the day, we see the market sell off. And again, this is the volatility that we're talking about. So we got to go through this, and I explained this in today's post, on our Technically Speaking post. It's on our website now. If you go to realinvestmentadvice.com, right there on the homepage, it's called Technically Speaking. It says Rules to Navigate a Contentious Election. But investing is important from the standpoint of having a discipline. And this is one thing we've talked about before. If you're going to invest capital, right, you've worked hard for, I don't know about you personally, but me, I've worked hard for my money and I don't like losing it, right? I prefer to keep it. And so I want to invest it. I want it to grow, but I also don't want to put a lot of my capital at risk. So having kind of a defined set of rules, and this is why we do talk a lot about technical analysis, when it comes to managing portfolios, doesn't mean we're not day traders, right? And we're fundamental investors. We're buying fundamentally sound companies that we like. We have a thesis around why we own these companies. Sometimes it works, sometimes it doesn't. If it doesn't work, we sell them. If it works, we add to them, right? But we have a general thesis that we're working with. But we use, and fundamentals tell us what to buy, right? We want to buy fundamentally sound companies. Technicals tell us more or less when to buy them, right? When the right entry point is. And it also tells us times that, we want to take some profits out, right? Raise some of our capital. Apple's a good example. We've bought Apple and held Apple for a long time now. But when Apple runs up and gets extremely overbought, we'll sell some shares off. And we sold some shares off of our Apple position several weeks ago before this decline recently that we saw in the company. And we've done that repeatedly over time. So we reduce our position, the stock pulls back. We're gonna add back to Apple at some point, just a question of when we get there, right? We're getting close to that point. So this is really what the rules define. They tell you how to navigate and manage risk in your portfolio. Now, and some of these are these rules are not new. They're not innovative. These are tried, tested, true rules that all professional traders use over time, and investors, from Warren Buffett to Paul Tudor Jones, all have got the same principle, right? Buy low, sell high. And it sounds easy, but it's not. It sounds easy. Oh, yeah, sure. I buy low and I sell high. Well, the problem is most people don't. They buy stuff and then they never sell it. And it goes up, and then when it comes down, and then they wind up turning all their gains back into losses, then they sell, right? So investors typically buy high and sell low. They don't do it the right way, which is to buy low and sell high, and that requires a bit of discipline and patience. The price of the market, regardless, and this comes back to the election, right? This morning, as we all stand here, we all have a different view about the election. Who's going to win, who's not going to win, who I like, who I don't like, whose policy I like better, all that. We all have our own opinion, and it's completely okay. That's what makes America great, right? I mean, that's what a democracy is all about. We can all have our opinions. It's a shame we can't all sit around and discuss our opinions without getting into a fight, but that's what America is about, is that we have this ability to have disagreeing opinions, and we should be able to talk about them and reach a better outcome that combines both of our opinions, right? We've lost that ability over the last several years, unfortunately, and you can pretty much blame social media for that because we all lock ourselves in our little independent social media silos. Social media certainly hasn't helped by helping foster these silos. But, we've lost the ability to communicate. But that truly is what makes America so great relative to every other country in the world is you try to voice your political opinion in some countries, they'll kill you, right? So don't forget that value. That's a real value. But when it comes to the markets, the price of the market is always right. It doesn't care what your opinion is, right? Pay attention to what the price of the market is because the price of the market is telling you what the market is betting on. And like I said earlier, people's jobs are on the line when investing capital. So if I'm investing capital based on my personal opinion, and my personal opinion is completely wrong relative to the market, I'm going to lose my job. So people tend to invest according with their analysis and their strategy, and they leave all their personal opinions outside. So pay attention to the market because the price of the market is always right. Number 3, every market or stock that goes up ultimately goes down, right? And this is one of the things that you've got to keep in mind. This is the buy low, sell high thing. When market prices go up, when stock prices go up, if you've got a huge gain in something, learn how to take profits because it will eventually go down. And then you'll have an opportunity to buy it back even cheaper, right? That's investing. Now, there's rules, and I've broken these rules down into categories. And so I wanted to get into a couple of rules here about building wealth because, this is our goal, right? We're not, we all like to kind of think of ourselves as traders sometimes, and particularly when you get into a really, kind of an aggressive market where momentum is and you're buying stocks that you really, I literally know people buying stocks. They have no idea what the company does. They're just buying it because the company goes up, right? So those things go wrong, right? But remember one thing is that, as I said earlier, I work hard for my money, and you do too. We all work very hard for our money. Our career is going to generate the bulk of our wealth. Whatever our job is, that's where the bulk of our wealth will come from. The stock market is only there to keep you wealthy. And if you can adopt this one philosophy into your investing, you will be better long term. The stock market is not meant to build you wealth. It's meant to preserve your wealth. Now, what does that mean? All that means is that when you invest your savings, those hard-earned dollars that you work for, you should invest them in a manner that grows your wealth, your savings, at a rate equal to or slightly faster than inflation. Now, look, inflation right now is running 1.5%, 2%. You don't have to stretch out there and take a bunch of risk to beat a 2% inflation rate. But that's the goal. If the majority of your wealth is coming from your career, investing is a function of making sure your purchasing power parity in the future, 30 years from now, is the same as it is today. If you take a bunch of risks chasing an S&P equity index and wind up losing 30 or 40% of your money, which will happen again, like it happened back in March, then you've set yourself back from your long-term goals. And you've got to make all that up, plus the inflation run that you were missing over the course of that time of getting back to even. Now, fortunately, this year, markets recovered very quickly. In 2008, it took 5 years to get there. So conserving capital is important into long-term building wealth, and understanding that your wealth is going to be built by your job, your career. That's where your wealth comes from, because you're going to save your money. Make sure that you invest in a manner that protects that capital over time. And again, don't assume you can replace your wealth. This is the other thing. People say, oh, well, I took this flyer bet out there. I put 50 grand or whatever into some stock and it blew up and went to zero. Oh, well, I'll make it back later. You can't replace your wealth because every time you lose large chunks of capital, not only do you lose the time of getting back to even, you've also shortened your window to your retirement time horizon, which now you're off target to that time horizon, and you've lost the compounding power of that money that you lost. Losing capital in the market has a much more deleterious effect on your overall outcome than just about any other aspect of your portfolio management. Look, all these rules are on the website now. Simply go to the website, realinvestmentadvice.com. Click on the link for our Technically Speaking post today. And if you're already a subscriber at our website, realinvestmentadvice.com, we'll email it to you today. You'll have it, and it also goes out to all of our clients as well. But go by the website, realinvestmentadvice.com. We'll be right back with more of the Real Investment Show. Don't go away.
Dale a la cuerpa, alegría, Macarena. Pues su cuerpo da la alegría, cuando buena. Dale a la cuerpa, alegría, Macarena. Hey, Macarena, alright. Dale a la cuerpa, alegría, Macarena. Pues su cuerpo da la alegría, cuando buena. Dale a la cuerpa.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you? Beyond the election, Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So this morning, 6:47 on this election day. That's right. Roll out of bed, get up, go vote. Put your coffee down. Time to get to work. It's almost 7 o'clock. Polls are opening here. I want to talk about just a couple of things here, as we kind of get ready to wrap up the show this morning. One is that, we've had a really sharp recovery in the markets since the March lows. And it's been good, right? We had this tremendous injection of stimulus that came in from the government as well as the Federal Reserve. The PPP program, Main Street Lending Program, the Federal Reserve started buying corporate bonds and junk bonds and everything else to try to bail out the markets, right? And we've written some articles about the dangerous side effect of trying to halt recessions and bailing out companies, et cetera. And as I was noting a second ago, particularly in the energy space, you've got to be careful about where you invest because of what's so-called a zombie company. There's a lot of value traps in the energy space you need to be particularly aware of. But this really kind of exists across the spectrum of the economy. We have more zombie companies now than at any other point in history that we know of. And again, what a zombie company is this is a company that only survives because they can borrow debt cheap to pay their other bills, right? And if interest rates move up, game over. So there's a good bit of risk in the markets. And we have taken on a bit of what's called moral hazard. And we wrote an article about this recently. If you go to our website, realinvestmentadvice.com, and just type in the search bar moral hazard, you'll find the article. But what moral hazard is, and it applies to a lot of things, right? Not just the financial markets. The definition of moral hazard is when people feel like they have insurance against risk, right? So there's some effect in place that says, oh, I can take on a lot more risk because now I'm insured. Example, let's say you go to Las Vegas and the hotel says, hey, you know what? You're a special customer, so go ahead and go gamble, but we'll insure your first $100,000 worth of losses. So if you lose any money and if you lose $100,000, we'll reimburse you. Okay. So now you have this insurance. And so you go, okay. So with that, you know that you can go lose $100,000 and not really lose anything because you're insured against that loss. So you go take higher levels of risk. You bet on hands and take, do gaming that probably you normally wouldn't do because you have this insurance sitting in the background, right? I know that's a bit extreme, but you get the point. Same way in the markets. What the Federal Reserve has done is created this idea. And here's the interesting part. It's just an idea. It's not really insurance, right? But over the last decade, the Fed has repeatedly come in and injected capital into the markets, and that capital has nowhere to go but the financial markets because banks aren't going to loan it out. I mean, why am I going to loan you money when you're not going to pay me back when I can invest it? I can take that same money, invest it in the market, make a guaranteed return, right? Why would I loan you money, right? This is why there's no monetary velocity in the markets. The money never leaves the financial system. And this is why you have a burgeoning wealth gap occurring all across the country, right? So the Fed has created this idea that there's insurance, that when the Fed acts, that stock prices go up. And there's certainly evidence that that's the case because that's what's happened. But there's actually no insurance. Investors are just taking on more and more risk with this idea that every time they get in trouble, the Fed will come in and bail the markets out. But in order to do that, it requires more and more and more debt to do it. And here's the irony of it. The bailouts are ruining capitalism. I've got an article coming out on this here next week. Capitalism is a system. And, you know, we take a look at this, at capitalism, and people go, oh, I hate capitalism because, you know, the rich people have all the money, I don't have anything, so capitalism sucks, it's broke, right? It's not. We just don't allow it to function. Capitalism has a Darwinian aspect to it. And if we allow capitalism to work, then the weak will perish and the strong will survive. Here's a good example for you. Let's go back to 2000. Turn of the century. I know for a lot of you that was a long time ago. By the way, I have to wish Brent happy anniversary today.
Why, thank you.
I went and looked back at my calendar. Today was the first day that I started to work for you in 2000.
Way back in the day.
Way back in the day. So today's our anniversary. 20 years.
Man. You don't look like you've aged a year.
I haven't. I have a special recipe. But here's the point, is that if we go back to 2000, and let's just assume that we'd allowed capitalism to function and work properly, what would have happened? Well, first of all, Enron, WorldCom, I know these are companies you probably have never even heard of, Global Crossing, they would have gone out of business. CEOs would have gone to jail, like Jeff Skilling and Bernie Ebbers. Oh, they did, right? We allowed capitalism to function back in 2000 during the dot-com crash. Weak companies went out of business. Strong companies survived. The economy went through a recession in 2001 and 2, came out of that recession, and was in a healthier position fundamentally and financially coming out of that recession. Now, in 2008, we decided that we didn't want to let that happen again. If we had allowed capitalism to work, guess what would not exist today? JP Morgan, Wells Fargo, Bank of America. Those banks wouldn't exist. They wouldn't be here because they were all bailed out by the Federal Reserve. Goldman Sachs would not be here today. AIG, General Electric. There was a tremendous number of companies that were extremely and heavily leveraged that had taken on excess risk. And had it not been for the bailouts, those companies would not exist today. But that would be okay because now our banking system, instead of being comprised, 60% of our banking system comprised by 5 banks, we would have a much more diversified and healthy banking system across the entire country. But we failed to allow capitalism to work. Since then, we have continued to intervene into the markets. Continued bailouts, continued supports, continued stimulus, etc. And what we've encouraged is a ramp up in debt, both at the consumer level as well as the corporate level. We've got a more heavily leveraged economy than ever before, ever. We're running a $3+ trillion deficit on our way to 4. We've got debt in the economy currently at 28 trillion, 26, 27, 28 trillion dollars now, ramping up very rapidly in a $19 trillion economy. And we all kind of sit around and scratch our heads and go, well, I can't figure out why we've got this big wealth gap between the rich and the poor. We can't figure out why we can't get wage growth to stick. We can't figure out why we can't get economic growth picked up above 2%, because we have failed to allow capitalism to work. And this sounds, and what I'm about to say sounds cruel, right? And every time I say this, people always email us like, it's cruel, that's terrible. You can't wish that on people. You've got to allow capitalism to work. People need to be allowed to file for bankruptcy. They need to lose stuff. And why do I say that? Because if you allow capitalism to work, all the people that took on all this debt to sustain their lifestyle, buy houses really they couldn't afford, buy cars they really shouldn't have, so forth and so on, they go through a bankruptcy process. Now, we think that's terrible, right? It's like, oh my gosh, we file bankruptcy, everybody loses everything, and they all just wind up out in the street, and they're all homeless. That's not the way it works. They go through the system, they file for bankruptcy, they shed their debt, they restructure themselves, and they move on. Yes, do they have to sell their house? Probably. They move into an apartment. It's not the end of the world, right? They still have a place to live. We used to shun people for a decade. If you had a bankruptcy on your filing, you couldn't get credit at all. Okay? Nowadays, nobody cares about bankruptcy. Get bankruptcy? Oh, good credit, bad credit, no worries. We'll give you credit. That's the environment we're in. And this is why we have the problems that we have, because we continue to extend credit to individuals that shouldn't be taking on more debt. And it has a negative impact to their economic wealth and prosperity over time, and creates this wealth gap within the country that we see today. And we can't make this connection. And yes, it sounds cruel and heartless to say we need to allow people to go through this process, but we need to allow people to go through this process so they can start over. If I refinance my house and I use a government program to lock myself into a house I couldn't afford to start with, now I'm locked into that house and I can't move to somewhere else in the country where I could get a better job. If I'm allowed to get myself out of the house, then I can move to where I can get a better job and I can start over. Starting over is not a bad thing. But this is the process, and this is the problem of not allowing capitalism to work, is that we foster the dark side of the process that leads to bigger wealth gaps, inequality, higher levels of debt. And the problem with all that is that as it continues to expand, growth rates slow, the wealth gap widens, and it creates the possibility for subsequent crises down the road because you've never resolved the debt problem to start with. That wraps up the show for the day. All these articles are on our website, realinvestmentadvice.com. That's realinvestmentadvice.com. Please get out of bed today. Go vote. Go do your duty and make sure that you vote your conscience. I mean, that's really all this comes down to. But pay attention to the markets and your money and let us know what we can do to help you. realinvestmentadvice.com. See you tomorrow.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.